Loan facility agreements. Credit facility. A credit facility is a type of loan made in a business or corporate finance context. It allows the borrowing business to take out money over an extended period of time, rather than reapplying for a loan each time it needs money. The facility size depends on the needed amount by borrowers and the amount that the lenders are comfortable in granting. There are two types of facility: committed and uncommitted. Committed and uncommitted facility are the terms and conditions of capital funding for both short or long-term agreements. The types of facility. Committed facility is a credit facility whereby terms and conditions are clearly defined by the lender and imposed upon the borrowers. In committed facility, the borrowers must meet specific requirements set forth by the lenders in order to receive the stated funds. Understanding committed facility. With a committed facility, once the terms and conditions of the loan contract have been agreed upon, the lender must advance money to the borrower when requested. In return, the borrower pays the lender a commitment fee. With a committed facility, the lender agrees to provide funds up to a maximum limit for a specified period of time and at an agreed interest rate. Although the terms and conditions are stringent and specific on how the funds are to be used, borrowers receive a guaranteed source of funding for the duration of the agreement. Types of committed facility are term loans and revolving credit facility, which we will talk about more later. An uncommitted facility is an agreement between a lender and a borrower, whereby the lender agrees to make short-term funding available to the borrower. Uncommitted facility are used to finance seasonal or temporary needs of businesses with fluctuating revenues, such as paying creditors to earn trade discounts, single or one-off transactions, and meeting payroll obligations. How uncommitted facility work. Small businesses may struggle to have adequate monthly cash flow. An uncommitted facility may help them operate until they establish a stronger presence in the marketplace and increase their annual revenues. Uncommitted facility are generally less costly to arrange compared to committed facility, because the lender has no obligation to extend the loan. When financing is made available, it is short-term, and the credit risk is comparatively small. Examples of uncommitted facility are overdrafts or working capital. Types of loan facility: term loan and revolving credit. In short, term loan is a lump sum of cash loan with a fixed payment schedule. Revolving loan is an ongoing borrowing and repayment credit line. A term loan provides borrowers with a lump sum of cash up front. In exchange for a specified amount of cash, borrowers agree to pay their lenders a fixed amount over a certain repayment schedule with either a fixed or floating interest rate. Term loans carry a fixed or variable interest rate, a monthly or quarterly repayment schedule, and a set maturity date. Understanding term loans. Term loans are commonly granted to small businesses with sound financial statements that need cash. It may be used to purchase equipment, a new building for their production processes, or any other fixed assets to keep their businesses going. Borrowers apply for term loans the same way they would any other credit facility, by approaching the lender. They provide statements and other financial evidence demonstrating their creditworthiness. Approved borrowers get a lump sum of cash and are required to make payments over a certain period of time, usually on a monthly or quarterly repayment schedule. Term loans carry a fixed or variable interest rate and a set maturity date. The loan requires collateral and a rigorous approval process. This is to reduce the risk of default or failure of repayment. Borrowers often choose term loans for several reasons, including simple application process, receiving an upfront lump sum of cash, specified payment terms, and lower interest rate. Taking out a term loan also frees up cash from a company's cash flow in order to use it elsewhere. Term loans come in several varieties, usually reflected by the lifespan of the loan. Short-term loans are loans that run for less than 1 year to 18 months. These types of term loans are usually offered to borrowers that don't qualify for a line of credit. Intermediate term loans. These loans generally run between 1 to 3 years and are paid in monthly installments from a company's cash flow. Long-term loans. These loans last anywhere between 3 to 25 years. They use company assets as collateral and require monthly or quarterly payments from profits or cash flow. They limit other financial commitments the company may take on, including other debts, dividends, or principals' salaries, and can also require an amount of profit set aside specifically for loan repayment. Both short and intermediate term loans may also be balloon loans and come with balloon payment. This means the final installment swells into a much larger amount than any of the previous ones. While the principal of a term loan is not technically due until maturity, most term loans operate on a specified schedule, requiring a specific payment size at certain intervals. However, term loans generally carry no penalties if they are paid off ahead of schedule. Revolving loan facility is a form of credit issued by a financial institution or a lender that provides the borrower with the ability to withdraw, repay, and withdraw again. A revolving loan is considered a flexible financing tool because it provides loans to borrowers with flexible terms of repayments and re-borrowing. It is not considered a term loan because, during an allotted period of time, the facility allows the borrower to repay the loan or take it out again. In contrast, a term loan provides a borrower with funds followed by a fixed payment schedule. How revolving loan facility work? A revolving loan facility is typically a variable line of credit used by public and private businesses. The line is variable because the interest rate on the credit line can fluctuate. The rate is often higher than rates charged on other loans, and the rate changes with the prime rate or other market indicator. The lender typically charges a fee for extending the loan. Criteria for approval of the loan depends on the stage, size, and industry in which the business operates. The lender typically examines the company's financial statements, including the income statement, cash flow statements, and balance sheet when deciding whether the business can repay a debt. The odds of the loan getting approved increases if a company can demonstrate steady income, strong cash reserves, and a good credit score. Use of a revolving loan facility allows a business to borrow money as needed for funding working capital needs and continuing operations. It is especially helpful during times of revenue fluctuations, since bills and unexpected expenses can be paid by drawing from the loan. The lender may review the revolving loan facility annually. If the company's revenue shrinks, the lender may decide to lower the maximum amount of the loan. Therefore, it is important for the borrower to discuss the company's circumstances with the lender to avoid a reduction in or termination of the loan. Seniority in finance refers to the order of repayment in the event a company is default. Subordinated debt and senior debt differ in terms of their repayment priority if a firm faces bankruptcy or liquidation. The senior debt is paid back before the subordinated debt. Once the senior debt is completely paid back, the company then repays the subordinated debt. Understanding the two types of debt. Senior debt is often secured. Secured debt is secured by the assets or other collateral of a company, and can include liens and claims on certain assets. Senior debt has the highest priority and, therefore, the lowest risk. Thus, this type of debt typically carries or offers lower interest rates. Banks typically fund senior debt. Banks assume lower risk senior status in the repayment order, because they can afford to accept a lower rate, given their low-cost sources of funding from deposit and savings accounts. In addition, regulators advocate for banks to maintain a lower risk loan portfolio. Subordinated debt. There is a risk that a company cannot pay back its subordinated or junior debt if it uses what money it does have during liquidation to pay senior debt holders. Therefore, it is often more advantageous for a lender to own a claim on a company's senior debt than on subordinated debt. With that said, however, subordinate department lenders get a high interest on repayment terms when compared to senior department lenders. Subordinated debt is any debt that falls under, or behind, senior debt. However, subordinated debt does have priority over preferred and common equity. Senior debt, subordinated debt, then common equity. Principal payment. In the context of borrowing, principal is the initial size of a loan. It can also be the amount still owed on a loan. The two types of principal payments are bullet payment and amortizing payment. Bullet payment is a lump sum payment made for the entirety of an outstanding loan amount, usually at maturity. It can also be a single payment of principal on a bond. The final payment is often the only principal payment made, but the balance might occasionally be amortized through other smaller, incremental payments before the final payment is due. The final payment is nonetheless significantly larger than the others, and it retires the loan. Loans with bullet repayments are commonly used to reduce monthly payments to interest-only payments during the term of the loans, but a large, final payment of principal eventually comes due. Amortizing payment. refers to a type of periodic repayment on a debt. If the borrower makes payments according to the loan's amortization schedule, the debt is fully paid off by the end of its set term. If the loan is a fixed-rate loan, each fully amortizing payment is an equal dollar amount. If the loan is an adjustable-rate loan, the fully amortizing payment changes as the interest rate on the loan changes. A covenant, in legal and financial terminology, is a formal debt agreement that certain activities will or will not be carried out or that certain thresholds will be met. Covenants in finance most often relate to terms in a financial contract, such as a loan document or bond issue. Covenants are often put in place by lenders to protect themselves from borrowers defaulting on their obligations, due to financial actions detrimental to themselves or the business. Covenants are legally binding clauses, and if breached will trigger compensatory or other legal action. Covenants are most often represented in terms of financial ratios that must be maintained, also known as financial covenants. Examples of such are a maximum debt-to-asset ratio, minimum dividend payments, minimum cash requirements, and even the number of key employees remaining with the firm. Other types of covenants include portfolio covenants, which requires the borrower to maintain performance measurements above agreeable threshold percentage on a monthly basis, 30, 60, 90 days. Examples are days past due and loss rates. And lastly, information covenants, which requires the borrower to provide all company financial and portfolio reporting to the lender. All the above factors are then used to draft a loan facility agreement, which is both beneficial and agreeable to both parties, borrowers and lenders. The facility agreements will include the loan agreement, which is the contract of the loan, security agreement, which includes interest payable, collateral, and guarantee agreement, which will have a responsible guarantor. Thank you for watching, and if you found this video useful to understand the factors that make up a loan facility agreement, please drop us a like below and share.